Hello, everybody. So we wrapped up chapter 20 last time and you guys had your project. I was pretty lenient on the grading on it. I didn't want to go through and discount every point on a 20-point assignment. So I basically looked over your worksheet and kind of graded you based on that. The other part of it, I didn't want to take off because it was formatting and things like that. So I didn't take off any points for that other part unless you did not complete it. But the answer key is out there so you can compare to what you had. And so with handout number 13, we got some practice questions there and I'll go over them in a few minutes. You guys would take a look at them and do your best or worst. Did you want a paper copy? You're welcome. Yeah, I just yeeted it. Oh yeah. My mom left. She was visiting me for a while. Came down to see me for my birthday. Thank you. Give it another minute and then we'll take a look at them. Okay. Let's take a look at the first one. Which of the following is not a retrospective type accounting change? So here you'd be looking for what's a change in, and you'd be looking for what is not a change in estimate. So if you have a change in estimate here, you know that it's not a retrospective type accounting change. And so completed contract method to the percentage of completion method for long-term construction contracts? Nope. LIFO method to the FIFO method? Nope. Sum of the years digits to straight line? Yes. And the full cost method to another method in the extractive industry. So our answer is C. Which of the following is accounted for as a change in accounting principle? So here we're looking at moving from something that was GAAP to something that's GAAP that's better for us here. And so the change in the inventory valuation from average cost to FIFO. The company changes from straight line method to an accelerated method of calculating depreciation, which will be similar to the method used for tax purpose. So here you're changing methods or changing estimates. And so the entry to record this would be a credit to accumulated depreciation because it's just a normal prospectively going forward calculation. John here is a star now. You put somebody on the front page of the website and you can just show up whenever. And by the way, there's no H in there, right? I'll do it for you. There he is. Yeah. And he's clearly explaining something exciting and fascinating. So must be talking about intermediate accounting 3, right? All right. Sorry, outed you there. Which of the following statements is correct? All right, so changes in accounting principles are always handled only in the current or prospective period. That is not correct. Prior statements should be restated for changes in accounting estimates. That's not correct. Most of the time you do it prospectively, meaning going forward. A change from expensing certain costs to capitalizing these costs due to the change in period benefited should be handled as a change in accounting estimate. So that answer is correct. Okay, which of the following describes a change in reporting entity? So basically we're looking for what was maybe reported as an equity method. Now it's in as a consolidated type thing. So you're jumping from say like 20% ownership or 25% ownership to now you have to consolidate the statements. Or if you think about selling an important segment, those things would require you to have have a change in reporting entity. So the only one included in here is changing the companies included in the combined financial statements. So we have C, D, A, C, and D. Now what I try to do is strike a balance here between things that are important to read in the chapter and me not standing up here talking so much. So you'll notice that these last few have had more of the information typed out and just a few places where you can kind of fill in the blanks. Means that I think these are important, but I don't want to do a PowerPoint slide or talk to you. I want to do the, kind of explain the background and then work through some problems. So these are still important. Reading the chapter is important. This just kind of highlights some of the important points. Okay. So there are 3 types of accounting change. The first one would be a change in accounting principle, which changes from one accepted GAAP practice to another. Usually these come about because FASB has made a change and now the companies have to apply that change. So typically an accounting principle change comes about because of the changes in the accounting rules. I don't think the companies ever volunteer for additional disclosure. There are a few out there that do it, but the FASB will look at it and say, you know, you couldn't do this before, but now you can do it. It is as much as we'd like to think not that it's not a political process, it is a bit of a political process. The FASB sort of says, this is what we think we should do. And then that gets opened up to a period of comments. And then based on those comments, they'll revise, or sometimes they won't revise. Now, that next step and whether or not it's going to become part of GAAP and the SEC is going to approve it, there is definitely some lobbying that goes on there and some control based on who's in the government, who's in power, and how much they're going to squeeze or not squeeze. So we've seen when the administrations change, the SEC top leaders change as well. And so their priorities are a little bit different. So you won't see consistently the same thing. A change in accounting estimate. So this would be a change in estimate based on new or additional information. And then the last one we talked about, the change in reporting entity. And so this would be just a change in the type of entity being reported, including changes due to restructuring. And that restructuring is usually when they're downsizing or getting rid of a business. And so they'll hold that one out. Sale or acquisition of a subsidiary. Or business combination are some of the examples. Basically, you're not the same entity that you used to be. And so here, mostly in this chapter, what we're concerned about is not only usefulness, but we also want to consider comparability. So some of the changes we apply backwards, some of the changes we apply current, and some of the changes we apply going forward. Okay, keep in mind, errors in the financial statements are not classified as an accounting change. And what are some of the things that errors result from? Math mistakes. Human error. Inaccurate application of accounting principles. So I heard somebody say fraud, and errors and fraud would be two different things. Like an error is kind of we made a mistake. Fraud is, we lied, right? I'm sorry? Not so much for errors, although if it was not applied correctly. All right, so we got a few of them there. That's good enough. So we have three types of accounting changes. The first one is retrospectively, and that basically means that you're going to go back and you're going to make an adjustment, and you are going to adjust retained earnings to the earliest year presented in the comparative financial statements. So typically in financial statements, you'll see 2 or 3 years presented. So if you have an application that you need to change the rules, whether it's through an error or accounting change, then you would apply it retrospectively, for example, a change in accounting principles, because they want to be able to compare it from the time that it affected your statements. Currently means the company does not recast prior year statements. If there was a prior year effect, it is adjusted to the beginning balance of retained earnings. And then prospectively means no changes to prior year, no reporting of the cumulative effect, and we just changed the new principle in the current or future years. Retrospective accounting. So now we're breaking down and we're talking a little bit. A company follows 3 basic steps. Adjust the carrying amounts of the affected assets and liabilities as of the beginning of the current year. The entry will include an adjustment to retained earnings for the prior year expenses and revenues. And so that's really net. And now we'll start to see the tax effect come into place as well. So they'll say either ignore taxes or give it to us net of taxes. So we'll start to see that come in here. But basically, we're going to be making an adjustment. It's going to affect our beginning balances. And the adjustment is going to be to retained earnings. Okay. Recast the financial statements for each period presented. So this is the retrospective. You're going back and you're adjusting all of the years presented in the financial statements. And the opening balance of retained earnings for the earliest year presented is adjusted to report the cumulative effect of change for the prior periods. And then the last piece you have to do is you have to prepare a disclosure detailing the change. The note to the financial statement indicates the nature of the change, why the company made the change, the years affected, and the impact on various line items in the financial statements. As you read through the chapter, you'll see that the disclosures are pretty long. And so as a result, a footnote may take up a page on the financial statements to indicate all of the principal changes with the retrospective approach. Okay. Now we're getting into the types of adjustments. Reporting a change in accounting principle. All years presented are shown using the new accounting principle. Prior years must be recast or updated, and amounts under the new principle. Part of this process includes showing the cumulative effect of the change on retained earnings. So you have to make sure that you're also disclosing that. When reporting changes in accounting principles, the retrospect approach must be used. And then it's a little note that says, unless impractical. Okay, these are just reiterating what's included up above here. Retained earnings adjustment, the other accounting change issues. So some of the other accounting change issues that you'll run into is you'll run into direct and indirect effects of changes. And I couldn't really find a good definition for direct effects, but I think that I have, sort of what characterizes it. So these are other effects that a company should report when making a change in accounting principles. The first one is the direct effects. And basically, These changes are recognized in assets and liabilities due to the change in accounting principle. And then indirect effects are any change to current or future cash flows of a company that result from a change in accounting principles. Okay, indirect effects do not change prior period amounts. A company should not use the retrospective application if the company cannot determine the prior period effects. I'm not sure how, or I can't give you an example. If you guys see one in the book or it comes up with one, please let me know. I just don't have a case where somebody in accounting can't go back and say, this is what would happen if we had this in place at the time. I mean, we're really good at recording things and making sure that we can make changes to them. So I don't know as much about forensic or fraud accounting that I'd like, but I think that they'd probably have some cases where they were like, but I don't know of a case where impracticability would cause this. So companies should not use this approach if the company cannot determine the effects of the retrospective application. It requires assumptions about management's intent in a prior period, or it requires significant estimates for a prior period, and the company cannot objectively verify the necessary information to develop those estimates. Now, there are a couple non-qualifying changes. So not all changes qualify as a change in accounting principle. And so the adoption of an accounting principle for new transactions. So if it never applied to you before, you don't need to go back and state it. Even though you haven't used it before, let's say you got a new asset or you're jumping into a new business. And so now you're going to be constructing some long-term projects. You don't have to go back and restate prior years because you didn't use it in the prior year. And then the other one is correction of an error. Correction of an error is not considered a change in accounting principle. Okay. So we have the following information to complete examples 1 and 2. And so it says Dream Home, a real estate developing company, was accounting for its long-term contracts using the completed contract method prior to 2024. In 2024, it changed to the percentage of completion method. The company decided to use the same for income tax purposes. The tax rate enacted is 20%. Income before taxes under both methods for the past 3 years appear below. What amount will be debited to construction in process to record the change at the beginning of the year? So we have to look and say, okay, what are the two methods? So under a percentage of completion, 2022 and 2023 income would be $1,125,000. Under completed contracts, 450 plus 300,000 equals 750,000. So the difference equals $375,000. And so that answer is A. And so what you'd have happen is you'd have a debit to construction in progress. And then you'd have a credit to retained earnings for $375,000. Any questions there? Okay, so now it says, which of the following will be included in the journal entry made to the Dream Home to record the income effect after taxes? So this is after taxes. So we have 375,000 net income difference. And so we take the 375 and multiply it by, we want it net of taxes. So 1 minus the tax rate, which equals 375,000 times 1 minus 0.2. And so that equals 300,000. And so the answer is B, a credit to retained earnings for 300,000. Oh, sorry, I should have changed those amounts. Just waving it up to let everybody catch up. We're going to jump to example 3. Lanier Company began operations on January 1, 2023 and uses FIFO method, costing its raw material inventory. Management is contemplating changing to LIFO and is interested in determining what effect will have on net income. Accordingly, the following information has been developed. So based on the above information, ignore income tax consideration. A change to the LIFO method in 24 would result in net income of. So we have net income computed under the FIFO method. And that's 750,000. And this would be less the difference between inventory values so we have LIFO 300,000 minus FIFO 360,000 equals a negative 60,000 adjustment to income. And so 750,000 minus 60,000 equals 690,000. Make sure you have time to look it over, ask any questions, fill out any information. All we're doing is looking at 2024 and saying, okay, we reported $360,000 in inventory. Well, if we change this new method, we'll only have 300,000 in inventory. If it's not an inventory on the balance sheet, where do we think it goes? Or where should it go? Should go to cost of goods sold. All right, let's try example 4. On January 1, Nelson Corporation changed to the percentage of completion method. The change is justified by Nelson Corporation. On December 31st, 2024, Nelson's retained earning balance was 1.5 million. Nelson calculated that if the percentage of completion method had been used, the accumulated impact on net income before taking any consideration of income tax effects would have been an additional $200,000. So it bumps it up. If Nelson's income tax rate is 25%, one of the impacts of this accounting change would be, so my understanding, the entry that we would be looking at here would be construction in progress, a debit for 200,000. And then you would have a credit to taxes payable. Oh, why is this doing this? And that would be 50,000. And then you'd have retained earnings for 150,000. And that okay. So what we would see is an increase in construction in progress of 200,000 on December 31st, 2024. Okay, and I'll give you guys about 3 or 4 minutes to do practice number 1. C, an increase to construction in progress of 200,000. Okay, so it says that the company changes method of accounting for inventory from weighted average to FIFO. This change causes the 2024 beginning inventory to increase by 960,000. So if our inventory increases, it's gonna have to come out of our previous expenses, right? So we have this 960,000, and we're gonna multiply it by 1 minus the tax rate. And that's gonna equal 768,000, and that is our answer B. So again, I think the entry that we're looking at here would be debit to inventory for 960,000. And then you'd have a credit to tax payable, and that would be the 20%. So 132. And then we'd have a credit to retained earnings for 768,000. I don't think I did that math right. 192? Okay, we'll check. Is the calculator today? 192. You are correct, sir. Thank you. Any questions there? Okay, now is time for our participation part of the show. Changes in accounting estimates. Companies must estimate the effects of future conditions and events. For example, the following items require estimates. So what are some of the things that we know require estimates? So recoverable mineral reserves. That sounds about like what you were saying, right? All in book form and stuff. What else? We use estimates for a lot of stuff, right? Do we estimate anything in the cash account? Think about your accounts. You got cash. No, we don't estimate anything in cash, right? What about accounts receivable? All right, so we have bad debt expense or uncollectible receivables. What's next in our line of current assets? Inventory, right? So what do we do with inventory? So we have to inventory obsolescence and also warranty liability. Gift card liability. What do we call it when you don't use your gift card and they write it off? So it'd be for unused gift cards. What about depreciation? Right, that's a big one. And then the other one is periods benefited by deferred costs. Ah, there you go. Thank you. You young people have good memories. So for changes in an accounting estimate, this means you didn't make a mistake, you just have adjusted it. And a lot of these will deal with depreciation, right? You may have set a straight line method, or you may have done double declining balance and you want to change it. You want to add years on, you want to take years off. That's stuff that's in the normal course of business. And presumably you have an economic rationale for doing this. And so changes in accounting estimate just say, from here on out, just go ahead and report that. Don't go back and report don't change previously reported financial statements. Okay, they account for the effects of all changes in estimates in either the period of change, if the change affects one period only, or two, the period of change and future periods. That's just stating the obvious. If you don't change the past, then what do you got to change? The current and future. Okay, we do differentiate between a change in estimate and a change in accounting principle, right? Those are different. If it is impossible to determine whether a change in principle or a change in estimate has occurred, consider it a change in estimate. And again, I don't know cases where they've quote unquote found it impossible for this. And then we also have differentiating a change in estimate and a correction of error. And it says companies should consider careful estimates that later prove to be incorrect as changes in estimates. Only when a company obviously computed the estimate incorrectly because of lack of expertise or bad faith should it consider the adjustment an error. Bad faith, not quite arising to fraud. Degrees.
Like that one example. Where executives had simply their retirement funds or whatever, talk to whoever about changing the bad debt estimate. It would make their numbers look better.
Right.
Not technically fraud, but changing it wrong. Benefited the executive.
Right. That
like a personal.
Yeah, that would be bad faith. So you're not really expecting it to change, but you're going ahead and saying it. Could be fraud, but I don't know. So changes in reporting entities, examples of changes in reporting entities. We talked about this. So consolidated financials versus standalone. Changing materials, subsidiaries. That are consolidated. Changing companies included in the combined financial statements. And then changing the cost, equity, or consolidation method of accounting for subsidiaries and investments. Okay, so in the year in which a company changes the reporting entity, it should disclose in the financial statements the nature of the change and the reason for it. So again, that's consistent with what we've seen. And it should report for all periods presented the effect of change from income. For all periods, the income from continuing operation and earnings per share. And then note that it's only required in that current year. They don't have to be included in subsequent years. So let's take a look at example number 5. Okay. On January 1, 2022, Piper Company purchased a machine, its only depreciable asset, for $900,000. Machine had a 5-year life and no salvage value. Some of the year's digits depreciation have been used for financial statement reporting and the elective straight line method for income tax reporting, which, unless we're dealing with income tax reporting, we can ignore, right? Effective January 1, 2025, for financial statement reporting, Piper decided to change to the straight line method. So how many years have we depreciated already? 3, okay. And so how it was calculated is they multiplied the 5 by 15 times the 4, or times our book value. And they say, you know, and I struggled with this a little bit, but apparently you can use kind of a shortcut and you can do 4/15 times 900. Oh, well, we shouldn't do it. So hold on. So 4/15 and then 3/15. And so what they do is they add all those up. 12/15, and they multiply that by 900,000 to get accumulated depreciation. And that's 720,000. So book value on 1/1/25 equals the 900,000 minus the 720,000. And it's 180,000. Now we have new depreciation. And that's 8 years straight line. And so we take the 180,000 and we're going to divide it by 2 because there's 2 years remaining. I got that wrong. Sorry, this is 5 years minus 3 straight line. And so that's 90,000. And so 750,000 minus 90,000 equals 660,000 pre-tax. So multiply by 1 minus 0.2. and we end up with net income of 528,000. Yes.
What's the, factor?
So they depreciated it based on the sum of the year's digits. So that was that depreciation each year. So one of the things I was wondering is because your book value is supposed to change. And so I'm gonna have to look at it again, but basically this is just how much depreciation that they incurred each year. They gave it to us. They said that it had the sum of the year's digits depreciation had been used for financial statement reporting. And so we had 3 years of that. So the sum of the year's digits formula is to take, let's say, the year. And so let's say it's year 5. So year number 1 of 5 years. And so what you would do is you take 5. Thank you. To calculate the rate, take 5 years and divide it by 5 plus 4 plus 3 plus 2 plus 1. And so that's your depreciation for the first year. So you multiply 5 over 15 by the book value, and that equals your depreciation in year 1. Now in year 2, you would multiply by 4 the number of years remaining times the book value, and that'll give you depreciation in year 2. All right, so let's take a look at example 3. Nope, example 6.
Do it separately. It's a current number.
That's what I thought, and that's why I have to go back and look at the sum of the year's digits, because this would not, like, to me, if we're looking at book value, I'm trying to get that little plus. Ah! All right. So I was wondering that myself. So like I have 5, 15, and then 900,000. And it basically makes it seem like they never adjusted it each year, right? So and see, that already seems like the book value would be. So the way that I would normally do this is I would get this for depreciation, but what I got to do is I got to go back and look and say, are they using an unadjusted book value in the historical cost? Like, I don't remember the sum of the year's digits being that way. So I think it's a mistake in the question, but I'll have to look at it. Okay, so cost basis minus salvage value. So here's the thing is that you just use 900,000 each of the years. Okay, so that's how they got that. And that's what I was wondering at first too. So it's a good question. We turned out to, I can't remember all the formulas, but you see what that is there. Good question. Thank you. All right, let's knock out.
Reduce the total number of years that you divide by.
So you did by like 4 by 5, 5 by 15, 4 by 14, 4 by 10. Okay. Right.
Then you do get 7.
I don't want to go messing with stuff, but I appreciate that. Take a look at example 6. So number 6, it says Nobel Corporation acquired machinery for 1.6 million. Nobel adopted the straight line method of depreciation for this machine and been recording depreciation over an estimated useful life of 10 years with no residual value. At the beginning of 2025, a decision was made to change to double declining balance method of depreciation. Assuming a 20% tax rate, the cumulative effect of this accounting change on beginning related earnings is 0. No adjustment to prior periods or change in accounting estimate. Okay, let's jump to number 7. Nobel Corporation acquired machinery for 1.6 million. Same information, adopted the straight line method. At the beginning of 2025, a decision was made to change to double declining balance method. The amount that it should report as depreciation expense for 2025. So we had a historical cost of 1.6 million. We had straight line depreciation. And it was for 10 years with no salvage value. So our amount 1.6 million. Divided by 10. And so we have 3 years times 160,000. So the basis as of 1/1/2025 is 1,100,000, 120,000, I'm sorry. And now we're going to use double declining balance. So we have 7 years useful life remaining. So that rate equals 1 divided by 7, or approximately 0.143. So we multiply by 2 for double. And so 0.143 times 2 equals 0.286. Trying to read my own writing here. So now we take our costed date of conversion, and that's 1,120,000, and we multiply. And when I multiply that out, I get 320,000. Any questions? Okay, let's look at example 8. Equipment was purchased at the beginning of 2022 for 850,000. At the time of its purchase, the equipment was estimated to have a useful life of 6 years and a salvage value of 100,000. The equipment was depreciated using the straight line method through 2024. So that's again 3 years. All right, so we have cost. $850,000. Then we have annual depreciation. And so we have 850,000 minus 100,000. And we have 6 years. And we have to multiply it by 3. So we have 3 years, 125,000. And so accumulated depreciation. Or no, I'm sorry, this is that was accumulated depreciation, the 475. And so our new basis is 475,000. And our new information salvage value equals now 62,500 and 8-year useful life, but already used through 3. So we have 475,000 minus the 62,500. And we're now dividing that by 5 years. And so that comes out to 82,500. Okay. And the last one is for your practice. It's similar to what we did on number 6, I believe. No. Example 5. It's similar to example 5. By the way, the first year's sum of digits would be 8/36. Okay, so I'll give you the answer first to see how close you got. The answer is B, 70,000. So the way we do this again is we total it up. We take the subtotal and multiply by historical cost, or the adjusted cost. This is 840,000. So accumulated depreciation is 490,000. So our book value $840 minus the 490 equals 350,000. So now we have our new depreciation, so straight line, 350,000 divided by 5 because there's no salvage value, and that equals 70,000 per year. Any questions? So we've got errors and I forget the fourth part of it to cover on Thursday, and you guys are free to go. Right, I just mathed it out for you, but no, always ask. Always ask. I may make fun of you outside of class. I mean, I don't do that. Yes. What's that? Yes. Did I collect them? Oh, okay. Yeah, give me a second. I'll grab you one.
I was like,
Is that for, did I give you guys one for, what chapter was that for? Is that for this chapter? 21? 20, okay. All right. I didn't give you any time to work on it.